Good afternoon, traders. Live from Indianapolis and streaming across the world, this is Shane with Futures IO. We are pleased to have you here and thank you for joining us for our 417th webinar event. Futures IO is a great trading community dedicated to transparency and bringing you quality education with webinars such as this. The basic membership is free. Head on over there and sign up. While you're at it, be sure to enter our Battle Stations Challenge for a chance at winning some big prizes. The competition is well underway, and there's some impressive trading desks out there, but it's not too late to join the challenge. All you have to do is share a picture of your trading desk. The entry is free. Also, if you post a selfie along with your trading desk, you're automatically eligible for a 50% discount off a Futures IO Elite membership. Navigating the waters of trader tax implications can be challenging, and for that reason, it is my pleasure to welcome back expert CPA Ryan Curran. Ryan started his career in public accounting back in 2007 and subsequently founded Curran Company in 2012 with the goal of providing high-quality tax, accounting, and advisory services to both businesses and individuals. Today, Ryan's going to update us on the trading tax landscape for 2021. I'm sure something that we are all going to be thinking about here very soon. After the presentation, we're going to have a Q&A session where you can ask Ryan any trading tax-related questions you may have. If we don't get to yours, it'll be posted over at Futures IO in the webinar thread. And as always, the event is being recorded, and it will be posted on the Futures IO website and at YouTube within 24 to 48 hours. Speaking of YouTube, our channel has over 400 videos covering just about any trading topic you can think of. Check it out, smash a few like buttons while you're there, share it with your friends, and definitely subscribe for all the latest updates. And finally, on social media, you can follow us on Facebook and also on Twitter at Futures IO. And now, without further delay, please join me in welcoming Ryan Curran.
Good afternoon, everyone. So I hope everyone's doing well. Thanks for joining me this afternoon. I appreciate it. Today's topic is going to be 2021 tax topics for traders. It's very similar to some prior presentations I've done, but the topic is informative. It's important for traders, and I think you'll find it beneficial. I've been involved in public accounting for, at this point, more than 9 years. I need to update this a little bit. I've been a CPA for 12 years. Got training at larger firms and have grown this business for the past 8 years from just myself to we have a team of 12 and 2 offices. I'm also a licensed attorney and practice, here and there on estate matters, business matters, so on and so forth. Okay, so just to summarize what we're going to be talking about. First, we're going to discuss trader tax status. Second, we're going to discuss mark-to-market elections and the implications of such. Third, we're going to discuss wash sales, tax reporting requirements, entity choices, and then we'll open it up to questions. So jumping right in, trader tax status. So this is basically a term of art in the tax code regarding someone who is an active trader, someone who's involved in the trade or business of trading. There's no formal definition of what constitutes a trader business in the context of being a professional trader. It's a facts and circumstances based test. According to IRS publication 429, the IRS will evaluate whether a trader is an active trade or business by reviewing a variety of characteristics. Namely the holding periods for securities bought and sold, the frequency and dollar amounts of trades during the year, the amount of time devoted to the trading activity, and whether the activity produces income. So just going down these points, typical holding period for securities bought and sold. Someone that's a professional trader is going to turn securities over quickly. They're not going to sit on them for a long period of time. So certainly the evaluation of how long you're holding positions is going to be relevant for purposes of whether you're satisfying, an appropriate holding period to be treated as a professional trader. The amount of trades that you're making, and I'll get to this a little bit later, but IRS and tax court cases have generally found that about 300 trades per year is acceptable. The amount of time you're devoting. If you're spending, 2 hours a day conducting trades and you're working a full-time job somewhere, that's generally not going to satisfy the criteria. And then finally, whether the activity produces income. Most folks who are trading and may lose money when they're starting, they want to be a professional trader because it can help them number one, potentially take the losses in excess of $3,000 during the course of a year, but number two, because it gives them the ability to write expenses off and lower their taxable income. So if someone's losing money every year on trading, the IRS is probably gonna disallow someone claiming that they're a professional trader. Furthermore, Pub 429 states that the trader must seek to profit from daily market moves. The activity must be substantial, and you must carry on the activity with continuity and regularity. So again, this goes back to holding periods. You know, you have to be trading, turning over your portfolio or positions in your portfolio frequently to try and make money. As I mentioned, substantial trading. Recent tax court cases, 300 trades is generally a good target. That's basically one trade a day, a little over one trade per business day, or more, depending on if you're involved in, you know, the futures markets, which you know, you can get involved in more than 5 days a week. Continuous and regular. So you have to trade consistently and regularly, basically dedicating a certain amount of time, keeping a calendar. If you're going to clock in from market open to market close every day or 3 to 4 days a week, that's probably going to be good evidence if you ever get challenged on whether you're actually a trader or not. Seeking profit from daily market moves. Again, the IRS is going to look at whether you're moving in and out of positions. If you are engaging in conduct that other traders that have been examined or would customarily be involved in are engaging in. Livelihood, again, are you making money? You know, you really, that's really the biggest thing here. You know, the IRS will generally allow a loss for an activity for 2 years. And if you don't turn a profit within 3 years, it can be considered a hobby. So if you lose money every year, that's generally going to be a negative with respect to IRS evaluating you as a professional trader or not. So just some good kind of recommendations here to avoid potential pitfalls or to take steps factually to exhibit to IRS that you are a professional. Incorporate your trading activity. And this can be, you know, whether you're a single member LLC, whether you're an S corporation, a C corporation, things of that nature. That goes to this concept called material participation. And if you are attempting to qualify as a trader business as an entity, it's much easier than as an individual because the IRS looks at each entity as kind of an independent entity, for lack of a better word there. And if the only thing that particular entity is doing is trading, the IRS is going to be hard pressed to say that this entity does not meet the level of a trader business for the sole reason that it's set up for. Whereas if you are just doing it as an individual, as a sole proprietor, if you have other activities, if you have rental properties, if you have a full-time job or a part-time job, things of that nature, the rules for folks to get to trader business, the IRS looks at all of your activities in an aggregate, and then they break them apart and look at them separately as well to see how much time you're spending. Point is, again, if you organize a trading business, XYZ Trading Corporation, and the only thing it's doing is engaging in, futures trading or stock trading, again, it's very clear that IRS is going to look at that and most likely say that this is clearly a professional trading activity, because that's all it's doing, right? Document prep, things that you should be doing. I mean, obviously trading logs, super crucial. Calendar. And again, block out your time for when you're trading, when you're not, when you're logged in. If you're doing research, just try and document the amount of time that you're spending on the activity. Again, maintaining trading notes, strategy, thoughts, etc. Like, you want to be able to put together or be able to demonstrate to someone that's auditing you that this is a real business, this is a real activity, this took a lot of thought, and viewing that preparation in conjunction with other characteristics such as the amount of trades, whether you're making money from the activity. Those are all factors that are very likely to allow the IRS to grant trader tax status to you if you're ever examined. The benefits of trader tax status, just some tax deductions that you get. So, ordinary deductions under IRC 162, home office, internet, subscription and terminal charges, research costs, retirement plans to the extent you're making a profit, such as a SEP, simple 401k, Roth 401k. One thing we've been pushing a lot from the retirement planning standpoint is the after-tax traditional 401k, which is called a mega backdoor Roth. This is where folks put in excess of $19,500 per year into a 401k, which is the current limit. And they can convert everything above $19,500 up to $57,000. They can convert that $37,500 excess into a Roth. So it's a really incredible strategy if you have the money to do so, if you have the earnings from the business to do so. You can also deduct health insurance for yourself. Moving on here, just some additional comments on trader tax status. Many people conflate trader tax status with mark-to-market election. These are two separate things, right? So again, common misconception here that the trader can qualify for TTS if they make a mark-to-market election. Again, it's not true. You can have someone that's, that's inactive with respect to a block of accounts that makes a mark-to-market election, or someone that's a participant in a hedge fund or an investment fund that's made a mark-to-market election, even though they have nothing to do with the business. They're still benefiting from the mark-to-market election just by way of being a partner in that particular fund. Trader tax status is totally separate. That's something that you're reflecting on individually if the facts and circumstances of your situation are such that you've risen to the level of being in the trader business of trading. Okay. And just to be clear, mark-to-market is an election related to the tax treatment of securities held by a taxpayer, which we'll get into in a little bit. And reiterating, trader tax status, again, solely facts and circumstances based, and that effectively enables you to deduct ordinary and necessary expenses on your tax return against other income and against any trading income that you have. Moving on to mark-to-market election. So the implications of mark-to-market. So one makes this election under IRC section 475. It can be extremely beneficial for traders. It allows a taxpayer who's made the election the ability to recognize ordinary income or loss to the extent of unrealized trading positions at the end of the taxpayer's tax year. In addition to allowing an unlimited deduction for realized losses, and that should be listed here as well, but that's also really important. The annual $3,000 capital loss deduction limit is therefore eliminated, and unlimited unrealized and realized trading losses are allowed as a deduction. The normal capital asset treatment accorded to securities is also eliminated. So what that means is, instead of getting capital gains treatment, if you sell a stock or you sell crypto, something like that, it becomes ordinary income and loss. So in the context of someone that has long-term capital gains, which probably wouldn't be relevant here anyway, because as we know, traders shouldn't have long-term capital gains generally, because you should be turning your portfolio over. In the context of someone that has long-term capital gains, you are losing the tax benefit of the long-term capital gain by having a mark-to-market election. However, again, that really shouldn't be relevant here, because if you're turning the portfolio over, you're not holding a security for longer than a year, it's all going to be short-term capital gains anyway. And then, there really isn't a difference between ordinary income and short-term capital gains from a tax rate standpoint. Once you make the election, it stays in force until you request a revocation from the IRS. And the revocation is, again, typically a very rare occurrence. A mark-to-market election can also be made with respect to certain classes of securities, which is really potent. So Section 1256 contracts, for example, you probably want to leave those free of any mark-to-market election, because a 1256 contract has two capital gains components, long-term and short-term. So as we mentioned earlier, mark-to-market will eliminate the benefit of the long-term capital gain treatment for a Section 1256 contract. So we might not want to elect mark-to-market for 1256 contracts in general. The mechanics of actually making the election. So this can be done several ways. An individual taxpayer, someone that's reporting their trading activity as, basically they're stating they're a sole proprietor, they haven't incorporated their business. You have to make the election for the current year by the due date of the prior year tax return. So someone that wants to make an election for this year, 2021, this says 2020, but we're going to talk about 2021 here. Someone that wants to make the election this year has to make the election technically by April 15th of next month. So what someone might want to do, if you're thinking about making this election, if you have large either unrealized losses or you have large realized losses as of right now, even large gains, you would want to think about making this election with respect to those securities. Has to be done by April 15th of 2021. It should be attached, the election should be attached to your personal tax return for 2020. So your 2020 tax return, which is filed April 15th, 2021, you should make the election on that return. Okay. Same thing for a business. Business has the same due date requirements with a couple of exceptions. So you have to file this form 3115 for a business if the business did not elect to be mark-to-market from its inception. So what some folks will do, if you start a new business, an S corporation, a partnership, a corp, if you file your first tax return and you treat your unrealized gains losses or realized gains losses as ordinary in nature, the implication being that you've already made the mark-to-market election. That is the accounting treatment that will continue until you request a revocation from the IRS. If, however, you report, let's say you open a trading business, or you've opened a trading business and you haven't made the election, you've reported the activity from the stock sales or the future sales as capital gains or losses, you will then need to make the mark-to-market election request, as I've stated here. So again, if you report trading activity the first year that a business entity is open, as if you had a mark-to-market election in place, that's the accounting method that IRS will use. If you report the activity without a mark-to-market election for 1 year, and you want to then use mark-to-market in the subsequent year, you have to make the election formally, as I've stipulated right here. And kind of bringing together what I said in my prior sentences there. So there's a couple different ways to make the election. New business, IRS states that an election must be maintained within business books and records within 75 days after the formation. So this is effectively, what I was saying earlier. We make the election internally. When we file the tax return, we should attach the mark-to-market election. But nonetheless, if we're reporting the activity as if a mark-to-market election is in place internally, that's going to be enough for the IRS to grant mark-to-market status. Okay, and then just like I said earlier, if the newly formed business files a return reflecting mark-to-market tax treatment, it's got to continue to use it. Sole proprietorship and single member LLCs. So this is kind of I guess what I'd consider potentially a loophole with respect, especially for single member LLCs. So a single member LLC or sole proprietorship files a Schedule C on a taxpayer's personal tax return. Okay. Because you have the ability to make an election for a new business without having to formally elect with IRS by the prior tax return's due date, there may be an opportunity to file a, kind of a quote unquote late election here without clouding IRS rules. So the point is, if you have a single member LLC and you are trading during the year, and you fail to make the election, say by April 15th of 2021, you form a trading entity in the fourth quarter of 2021. You keep this quote unquote internal election in place, and you file the election with your, by April 15th of 2022. Theoretically, you'd be able to take mark-to-market treatment on any securities in that entity during the year. So that's, again, to my knowledge, it hasn't been challenged by IRS. To me, it seems like a bit of a loophole, but it is something that potentially could work, especially if you fail to make a mark-to-market election in time. The issues of making the election. So late filing. There's no reasonable cause relief for a late filing of mark-to-market election. Okay. There are guidelines regarding how the Internal Revenue Commissioner can grant a late election, but it will only be granted if the person discovers the issue, then immediately files it, and it doesn't prejudice the IRS. Prejudicing the IRS is, again, a term of art in private letter rulings and Internal Revenue Code sections and IRS guidance that's been debated for and litigated for many, many, many years. But generally speaking, prejudicing the IRS means that if you're going to lower the taxes that are due to the IRS, then it prejudices the IRS. Point is, most folks that are seeking late mark-to-market election have large losses and they're trying to lower their tax liability. So if that's the case, then it'll probably prejudice the IRS and likely it will be denied. Now, if someone has say a net operating loss, for example, or they've lost money from investing in a business of some kind, and they fail to make a mark-to-market election, if they're not going to pay tax anyway, then arguably the IRS isn't prejudiced. So in that situation, it may work. But if it's someone that has, $1 million of gain from selling a piece of real estate and they want to elect mark-to-market after the fact to lower their $1 million of gain, probably not going to happen. Okay. Now, again, one other major pitfall we discussed briefly earlier, removing capital gain or loss treatment on all securities. So if you have securities that you're holding personally or that you may move into an LLC account, for example, and these are, let's say you own Apple stock for 20 years and you have huge long-term capital gains built in. If you make a mark-to-market election on that LLC account and the LLC is custodying this Apple stock, for example, that Apple stock is going to all become taxable to you. All those unrealized long-term capital gains will be realized under the mark-to-market election. So you have to be extremely careful with respect to what securities you're electing mark-to-market on. Okay. Same thing I mentioned earlier with 1256 contracts. So 1256 contracts already are marked. You get a 1099-B from any of the clearinghouses or the futures brokers that you're using. That gets reported appropriately. So if you make a mark to market on 1256 contracts, you're basically going to lose that tax benefit. So again, my advice here would be, my informal advice would be, don't do anything with respect to 1256 contracts. Like, that should just be a separate account. When you make a mark to market election, you can be very specific with what accounts you're actually electing for. You have to make sure that if you're doing any futures trading, that the election does not apply to any futures based accounts. Moving on to wash sales. So this is a fun area for professional traders who have almost certainly all had experience with this. So pursuant to Internal Revenue Code section 1091, a taxpayer realizing a loss by selling a position is disallowed if they buy back the substantially same position within 30 days of the initial transaction. So I want to sell all my positions December 31st, 2020, because I think that I'm going to get a huge capital loss and it's going to be great. And I'll be able to offset capital gains, right? Well, this section says, and then furthermore, I decide I'm going to buy back that stock next week, the week after December 31st. Get back from the new year, January 7th, I'm buying back all my positions. Under this rule, all those losses that I realized at the end of the year are no longer allowed. I have to recapture all of those. So all that smart planning that I thought I was doing is irrelevant based on this code section. Okay. So there is relief for professional traders in particular. Okay. So pursuant to publication 429, which again, this is the IRS publication that governs professional trading and is really the most information the IRS has publicly offered about this topic. So anyone that's on, if you want to make your eyes bleed a little bit, just read this publication. It's great. But anyways, according to that publication, a taxpayer who qualifies as a trader and who makes a mark-to-market election is allowed to disregard the wash sale rules. So if someone is a professional trader and has a mark-to-market election in place, the strategy that I was doing earlier when I was selling everything on 12/31/20 actually works really well then. There's no requirement to basically track 30 days and disallow losses. Okay, there's another potential loophole here that I've looked through over the past year or so in practice, and we found a contradiction in the code. Basically, the implication here, regulation 1-1091-1, IRS specifically excludes individuals who dispose of securities in connection with a taxpayer's trader business. Point here is that if someone is in the trade or business of securities trading and doesn't make a mark-to-market election, my reading of this regulation is that they're still not subject to wash sales. Now, this is a point that really has not been litigated to my knowledge. The IRS has not ruled on this. Again, there's a very clear conflict in the tax law. This is a potential loophole, potential avenue for folks that did not make a mark-to-market election, but are professional traders to avoid wash sales. Regardless of that, my overall point here is if you're going to trade professionally, you don't want to be hit with wash sales, you need to make a mark-to-market election properly. Or you need to be extremely cognizant of trading into positions within 30 days. Next up, reporting requirements. This is basically a primer for where various professional trading activities are reported. So this should be actually very helpful. So trader tax status, if you qualify, if you want to take deductions for it, if you file a personal tax return, you're going to report deductions all on Schedule C with no income, okay? Some folks make a mistake of reporting income and expense. That's not correct. You have to report just the expenses on Schedule C if you're a professional trader. If you're a business entity, you're just going to quite simply file your expenses on the actual 1065, 1120, or 1120S form, just like you would any other business. If you make a mark-to-market election, there's gain or loss. You're reporting this on Form 4797, Part 2, as ordinary income or loss. Very simple. There is a requirement to separately list transactions if you're mark-to-market. The IRS has provided some relief for, say, retail investors who sell securities. You can basically just summarize gains or losses by category on Schedule D in Form 8949, breaking down into short-term, long-term, covered, non-covered. What we do for our returns, we just one line item for each category. Keep it simple. However, if you're mark-to-market, each transaction needs to be listed separately. So this can be very arduous if you have thousands of trades. You need to make sure that the trading activity is attached to your return as a separate PDF. Or if you have a tax preparer, you need to make sure you give the preparer the actual trading summary. It has to agree to what you're reporting on your 4797 to avoid any issues. Okay. 1256 contracts, they're all reported on Form 6781. Unless mark-to-market's been elected, then it's 4797 Part 2. Entity choices. So this will just cover basically my thoughts on which entity types are the best for trader tax status. So individual taxpayers. Historically, the IRS has audited individuals way more frequently than businesses. In particular, for Schedule C businesses, especially in the case of professional trading, where a properly reported Schedule C is never going to have any income. It's only going to have expenses. So that's an immediate flag for IRS, okay? You can almost guarantee that depending on the losses that you're trying to take, you're going to get an audit if you have professional trading on a Schedule C over a long period of time, okay? And again, this is primarily because of the losses that I've mentioned, but also just the nature of trading activity in general, and IRS's confidence and historical ability to attack and overturn deductions that are improperly claimed as a professional trader. The negatives, just some more of these points, you cannot make a retirement plan contribution under this strategy, okay? And as I mentioned earlier, the proper treatment of mark-to-market losses and business expenses is you report mark-to-market gains losses on 4797 and business expenses on Schedule C. Again, we're not reporting gains from trading on Schedule C as income. It just does not happen. It has to go on 4797. Overall, and I think you can probably hear from my tone, like the best thing for a trader to do that's really, a professional trader that's trying to do this is form a separate entity. Entity choices. Entity formation to take advantage of trader tax status. So as I mentioned, and in my experience practicing 12 years, I've never been personally involved in a partnership or S corporation audit for a client. I've represented some clients that have come to me from other CPAs that have had a S corporation audit, but in that situation, there was just some very flagrant malfeasance, if you will, with aggressive deductions. Generally speaking, a competent CPA that's preparing a reasonable S corp or partnership return is not going to get audited by the IRS. Point is, this same strategy and logic would apply to folks that have trading entities. If one of the goals is to try and avoid an audit, then having a separate entity is going to be a good way to do that. Secondly, you can use retirement accounts if you have an S corporation in particular. And the way to do this is if the business is producing cash flow from trading and you have a mark-to-market election, you can pay yourself as an officer of the S corporation a W-2, and you're able to make 401k and SEP contributions as a result. Okay. You can also accomplish this through an LLC using guaranteed payments. It's a little messier of a process. I would never recommend it in this context. As I mentioned, you can have health insurance. If you have employees, you can have a group plan as well, which is pretty cool. So having a business entity does generally make it better for trader tax status. Again, as I was alluding to in one of our earlier slides, if the sole purpose of the entity, again, XYZ Trading Corp, if the only thing you're doing there is trading securities, the IRS is going to be hard pressed to say that this is some other entity and you're not in the trader business of trading, right? So having a separate entity for it just tends to check that box. Okay. I think that's pretty much it for the substance of the discussion. I think I'll turn it over to questions.
Right on. Hey, Ryan, can you hear me now? Okay, so Ryan can't hear me, but I'm going to go ahead and forward questions via chat.
Okay, I got the question here. Thanks, guys. Okay, so Mert MJ would like to know what to do in a situation where one wanted to elect mark-to-market with both securities and futures. Can they be done separately instead of a blanket election? I mean, yes, they can, right? The mark-to-market election can specify very clearly exactly what buckets of securities the election relates to. Again, the thing that I'd recommend is just keep them in separate accounts, even separate entities. If you're going to do 1256 stuff, maybe just do it in your name, and then securities trading, do it in an entity name. You can get really creative, and the segregation is really important.
Yes, Mert MJ would like to know if you recommend a C Corp or S Corp for groups of individuals.
Do I recommend C Corp or S Corp for groups of individuals? So for groups of folks, I'd probably recommend a partnership, an LLC. It's much more flexible, and if each partner has their own set of rules or their own deal with the entity, for example, then having an LLC makes it very easy to allocate everyone's performance to them individually. Whereas an S corporation, you must have proportional distributions, income allocation based on your ownership. So saying it a different way, if you have two partners, you're 50-50, and one person really made 75% of the profit, in an S corporation, each partner still has to get allocated half and half. Whereas in LLC, you're able to allocate 75% to one partner and 25% to the other. So for groups of individuals, I'd recommend a partnership. The C corporation also works, although with potential tax changes coming up, a C corporation, particularly if there's profits, may not be as beneficial for folks.
All right, great. It looks like that's about it for the questions.
Appreciate it. Hope this was informative. Feel free to reach out to me if there are any questions. I'll put my email in the chat box. And be well, everyone. Hope everyone's safe.
All right.
Notice that I'm not wearing a mask here because I'm alone. All right, guys.
All right. Thanks again, Ryan. Be sure to join us for our next event for an afternoon with our very own Lance Stranahan, a.k.a. Lancelot Trader. Lance is a 13-year trading vet, and he's going to give us some insight on how to tame the beast that is NASDAQ. And also, don't forget, please hit that like button on YouTube. Head on over to Futures.io to continue the conversation with Ryan and participate for free in the Battle Stations Challenge. Again, I thank you for joining us, and trade well.